In 2008, US Treasury tax revenues collapsed. In 2020, tax revenues collapsed. And I would argue that that's one of the main reasons why the Fed panicked so quickly and announced all these emergency liquidity programs and announced quantitative easing because of how quickly the tax revenues collapsed. And one of the main priorities for the Fed is making sure all levels of government are fully funded.
Yeah, the treasury market and the repo market really are some of the quickest acting markets where the Fed will jump in if there's a problem. And so people often say, how far does the stock market have to fall before the Fed jumps in? And it's like, well, that's not the main market that if it falls 20%, they're freaking out about. So a more important market than that is the credit market. If the credit market seizes up, that freaks them out. And then even more than that is something like is supposed to be super well functioning, like repo or like treasury market. If that breaks down, that's when they literally have like emergency meetings and step in. And so back in late 2019, there was a repo rate spike, and repo was heavily used by entities that were buying T-bills. And so basically that spike, if left unaddressed, would have translated eventually into the treasury market. It would have, that fire would have spread. And so you saw rather, within one day, the Fed had responded to try to reliquify the repo market, and then they had the transition into just directly buying T-bills. And so basically that was the whole famous, it's not QE, they were calling it. They were obviously doing QE, but then not calling it QE. Due to semantics around it being only T-bills and not T-bonds. And then when they had March 2020, when they had basically the lockdown crash, you had a dollar spike because there's over $13 trillion of dollar-denominated debt in offshore markets. Most of that's actually not owed to the U.S. Most of it's owed to Europe, Japan, China, multiple different countries, but it is denominated in dollars. And so you had basically dollar cash flows drying up as global trade came to a halt, but those debts are still due. I mean, those debts represent demand for dollars that have to be serviced. And so you had this huge spike in dollar demand, and the world was short dollars, but a lot of entities still had dollar-denominated assets, including treasuries. So they can sell treasuries to get dollars, and that market basically went no bid. Treasury market liquidity completely dried up. It was basically broken. And so you had an emergency meeting from the Federal Reserve, and they printed $1 trillion in 3 weeks, to reliquify the treasury market while launching that alphabet soup of different programs. And so I think that, yeah, if you have a seize up of some sort in the treasury market, you'd have the Fed in there very quick. And, they might do the same thing again. And they also have kind of other ways they can reliquify the treasury market if it becomes a more structural problem.
I think you just laid out in detail how fragile everything is because of too much leverage in the system, too much debt. This is a problem with fiat currencies and bad policies from governments and central banks. These governments are too big. And then every time there's a problem, especially here in the United States with the Federal Reserve Bank, they think that they can just paper over it. Eventually there will be consequences, although right now here in the US and in other countries, we are feeling the consequences. Regular people, we're getting much, much worse stagflation. And then unfortunately, I think our taxes are also going to go up too.
I think we'll see about the tax part, because the thing is that we're going to have what looks like a divided government. Even now, we already arguably have a divided government because you don't really have like a filibuster-proof Senate on the side of the president, and based on poll numbers, there's a very, very high probability that the government's going to be more split after the midterms, and so it's actually going to be very challenging for them to get through tax changes in the next 2 years. And so I think, if anything, you could see, kind of like how in Europe and the UK, you're seeing these kind of like targeted energy stimulus. We see now they're floating ideas of like, in the US, basically taking away tax on gasoline and things like that. I think you could see some of these emergency policies to try to rein in some of the stagflation, but that just widens the deficit further. And so I actually think that part of why the treasury market is going to be in a weird state for the next few years is because they have little control over their expenses. A lot of them are just kind of mandated into law, but they're also not going to be able to move the revenue side for at least the next 2 years, maybe longer. And so those deficits are kind of locked in, and then they're how much their spending is kind of locked in, and then as their tax revenue fluctuates based on asset prices and economic strength, their deficit can widen, and I think that's why we're going to see action from the Fed to reliquify that market in the quarters or years ahead.
About 80% of US federal government spending for their budget is normally locked in about 5 years in advance. So the average person, when they go and vote, or they see a politician talking on TV and thinking that the politician can take immediate action and cut a bunch of expenses, that's just not how things work here in the DC metro area.
Yeah, and it's also that they usually, when they're elected, they usually don't have like the full majority to do whatever they want. I often see people say the government's going to do this or the government's going to do that. Whereas, most governments in modern history in the U.S. don't have sweeping powers. They kind of they keep gridlocking each other anyway. Some would consider that a good thing. I mean, some of the best market action happens when government is gridlocked. Um, but either way, basically, I think that we're in a situation now where there's very limited options for new revenues or tax, or certain types of tax cuts. I think it's just kind of policies kind of frozen in for the next number of years, and we're going to be hit by these events that are happening. And some of their policies cause this, some of these policies, you can say added to it, and then at the same time, their hands are going to be somewhat tied on, their ability to do anything about the budget itself. And so I think that's going to be a structural issue for the treasury market. I'm not calling for that right away. I mean, we are starting to see that the treasury market liquidity is going down. So it actually is kind of starting to happen around the margins, but they don't have a lot of treasury issuance at the moment. And it's because of the fact that they kind of pre-issued it. They had good tax revenue, so they lowered how much they expect to have to issue treasuries for the next couple quarters. But I think when you look beyond that, it does get pretty messy looking for the treasury market.
But didn't China and Japan just announce in the last week that they won't be adding to their treasury positions? I mean, Japan's going through a lot of problems now. Japan may have to sell their treasuries to get dollars if problems continue to arise with the Japanese government bond market and the Japanese yen.
Yeah, we're seeing around the margins that Japan already sold over $100 billion worth of treasuries. And that's somewhat lagging data. It's like reported with like a 2-month lag. So it could have been a little bit more by now. And then we also have, China actually announced back in, what was it, 2013 or 2014, there was no longer the national interest to keep accumulating treasuries, and they've stuck to that. You've had kind of this flat to mildly down situation for Chinese treasury holdings. And then you can also look at the Federal Reserve has data. Basically, there's two, kind of main sources for foreign treasury holdings. One is from the Treasury. That's the more complete set, but that comes out with a lag every month. And it looks back about 2 months. And then the Fed reports custody data because they hold a lot of the treasuries for foreign entities, for foreign official entities, their central banks, especially the smaller ones. And that represents about half of the foreign treasury market. And so that actually is updated weekly. And we're already seeing that as the dollar has been strengthening for the past several months, the foreign exposure to treasuries has been slowly inching down. So it hasn't become disorderly yet like it did in March 2020, but there's basically no net bid by the foreign sector. So, individual countries might add, other individual countries might be selling. But right now, their overall net foreign exposure is flat to down, which again is not a huge problem because there's not really much issuance in these couple quarters either. But the problem is if that situation persists, and then they get to a part where they have to increase their issuance again, that's when I think you get a potentially disorderly treasury market.